the narrative in Western markets tends to be very extreme. You know, all the discussion recently, balance sheet recession, is China becoming Japan in 1990? Things start turning around a bit, and I think we'll get the opposite extreme. What's happening on the ground in China is, yeah, we're getting a bit of a recovery. Things are pulling around a bit, but it's way below the expectations of international markets. That's why I think we're getting these extreme narratives. You know, when you delve into what's going on the ground, okay, consumption has picked up in certain areas. People aren't spending as much as before. Investment is kind of ticking along, with the notable exception of the property market, of course. So what we're seeing, and kind of what China's leaders also have been broadcasting that they expect, is this tortuous, drawn-out recovery. It's not as smooth, it's not as stable, it's not as strong as some other countries, but it is still happening. And when things start to slow down, we're also seeing Beijing very ready to step in to provide a bit more support, as we've seen with the property sector over the weekend.
Let's go back to the trade numbers that we were talking about at the top of the show. I guess one of the mistakes that we're falling into is analyzing them from the perspective of China alone. But of course, it's trade. So you have to think of the other side of the equation. Coming at a time where just now, you know, we've been analyzing European data, it started to really slow down quite a lot. US soft landing territory, but again, growth is moderating there. To what extent are external forces, external demand also going to affect China's economic prospects going forwards?
Yeah, absolutely. I think we should bear in mind external demand. The global demand picture is still, I think, quite weak for the rest of the year and going to next year. On top of that, an additional thing to bear in mind with China is during the pandemic, Chinese exports really benefited in a kind of one-off way, because it was the last factory standing in the world at some points, and people were buying, you know, computers, work at home goods, devices, all the things you need to work at home. And now what you find is global consumers have got too many of these things. So I think what we're going to see is a kind of structural fall off, and we are seeing that in demand for electronics and those kind of things, and that will last a bit longer.
Well, you know, a lot of the economists we speak to flag that goods disinflation has been a lot more pronounced than services inflation for that precise reason, as a function of the pandemic. In terms of policy response, what further steps are you anticipating out of authorities in the next couple of months? What more measures could we see?
Well, I think the measures we're going to see actually in the next set of data next week, when we start seeing lending data and some of the real economy investment data, is we will start to see a pickup in some of the traditional investments. So I'm talking about infrastructure, manufacturing investment. I think there's going to be an acceleration. There's already acceleration of the funding for that, local government bonds. That will start to feed into investment for the rest of the year. And then on top of that is the property sector. You know, there's been an easing over the weekend to support home sales, mainly in Tier 1, Tier 2 cities. I think the next question is whether that is sufficient to turn around the broader property sector and to cushion the sort of financial risks related to Country Garden and so forth. Country Garden, Evergrande, very exposed to lower tier cities, so not direct beneficiaries of the recent support. So I think there is a possibility, perhaps a rising likelihood, depending on whether confidence picks up, that China will add a bit more support directed at some of the lower tier cities, as well as some kind of developer funding measures to ensure that risks are contained.